Welcome to Video23D, the very last video in Accounting 332 summer of 2018. You may go ahead and cheer now. Okay, we're going to deal with the unitary concept, and this is a bit tough to understand, especially because you're just trying to get your hands around state income taxation through allocation and apportionment. And what this does is it throws in a little bit of a twist. So here's how we're going to explain the twist. KEY Inc. manufactures gloves, and they have 3 factories. There's one in Boston, Mass. That's where their headquarters are, and it's where their design operations are. They have another one in Las Vegas, Nevada, where they do the cut and assembly of the cloth. And then lastly, they have a location in Anaheim, California, where they perform final assembly and add decorations, accessories, and other sort of bedazzling type things. And then ultimately, that's where their warehouse for inventory is. And off it goes to all the different places where the gloves are sold nationwide. So for the purposes of this particular example, let's look at 3 tax rates in these states: California 8.4, Massachusetts 8.8, and Nevada 0%. These aren't actually the tax rates in all 3 states, but it's worth it for the example to understand it. Okay, so under the current structure, what would happen? We take the total income for whatever it is for the world, right? And we determine how much sales, property, and payroll we had in California, Massachusetts, and Nevada. We divide it up, and ultimately every state would get its share, with a piece going to California, a piece going to Massachusetts, and a piece going to Nevada. However, our tax advisor, SpongeBob, decides he has an idea. And so we know from the beginning that this is not going to be a good idea, but we're going to walk through SpongeBob's thinking so we can understand how the unitary concept came to be. So SpongeBob says, you know what, we're going to change the corporate form. We're going to be 4 different corporations. There's going to be KEY at the top, and we're going to incorporate in Delaware. And then we're going to create 3 subsidiaries, one in Massachusetts, one in Nevada, and one in California. And then we're going to structure the sales, the intercompany sales between sub 1 to sub 2, sub 2 to sub 3, so that each subsidiary only has nexus with the state in which it's located. So, for example, subsidiary 1 only has nexus with Massachusetts. Subsidiary 2 only has nexus with Nevada. Subsidiary 3 only has nexus with California. So as a result, they would only file in those states. And of course, since Nevada has no corporate income tax, they're not going to file there at all. Okay, so now that SpongeBob has designed this particular corporate structure, he's going to adjust the way things are sold from sub 1 to sub 2 and sub 2 to sub 3. So what happens is these are intercompany transfers, so they can set the price wherever they want. So what happens is they decide that the fabrics are going to be sold from the Massachusetts sub to the Nevada sub for just over what they cost to make. So let's say that normally the cost is 24 cents. They're going to sell them to Nevada for 25 cents. Therefore, they're only going to make a penny a unit. Now, the assembled gloves are then sold from Nevada to California. And in order to deal with that, they're going to price the gloves so that they're almost at their full retail value when they're sold to California. So the Nevada sub sells them for 99 cents. Their cost is 40 cents, so that's the 25 they're paying plus whatever they put into it. And so the profit in Nevada is a whopping 59 cents per glove. And then lastly, the final product is sold out of the California distribution center. And let's say that they typically sell those for $1 to the consumer. Since California bought them at 99 cents, they are making a penny profit per glove. So recall, Nevada has no corporate income tax. So as a result of this tax planning structure, which is 100,000% perfectly legal, you can see that what's happened is all the profits have been shifted to Nevada. And strangely enough, oh, that's weird, Nevada has a 0 corporate tax rate. Well, you know that couldn't last. And you should be proud of being a current resident at least, of the state that invented something known as the unitary concept. Okay, so the unitary concept doesn't mean that the state has the power to tax all of the unitary business. It simply means that rather starting with, let's take California as example, only with California's income, the unitary concept says, no, we're going to examine the entire unitary business, and that's going to be the starting point of our allocation and apportionment. So think of it as just the California subs actions and activities are not all that's in the state tax base. It's the state tax base of the entire unitary company. So if we were to flip back, it would be all of the subsidiaries are unitary. Okay. So California and Massachusetts, for example, are both unitary states. More and more states are going unitary. At my last count, there were 24 of the states that had a unitary concept in place. So the Supreme Court identified 3 factors that are used to determine whether a group of businesses is unitary. The first is, are they functionally integrated? For example, vertical or horizontal integration or knowledge transfer. Well, if you think about the example we just walked through, that is total vertical integration, right? We went from step 1 to step 2 to step 3, ultimately to sell a completed glove. So it would be a really difficult case to say these activities weren't functionally integrated, and as a result, it's not unitary. Secondly, centralization of management. Notice that we had a parent company that had all the centralized management inside of it. As a result, that would be a difficult battle. And lastly, economies of scale, where you see that as a result of the operations of the way things work, there's economies of scale due to size. So the unitary concept pervades activities in the entire income tax system. And so what we need to do is an example. So Donald Corp, a wholly owned subsidiary of Disney Inc., generated a $400,000 taxable loss in its first year of operations. And Donald Corp's activities are restricted to state A, which has an 8% income tax. Disney's income for the period is $1 million, and Disney's activities are restricted to state B, which has an 11% income tax rate. Both states use an equal weighted 3-factor apportionment process, and both are unitary. So if the apportionment factors are as follows, and I'm just giving those to you, you don't have the data to calculate them, but let's presume for a second I've given them to you. What is Disney's tax liability in state A and state B? And then what would it be if they weren't unitary states? Okay, so let's remind ourselves of these numbers. We've got Donald with a $400,000 loss in state A, and we've got Disney with $1 million of income in state B. Okay, now let's move forward. So what we need to do is use the unitary, since both of these states are unitary, we would combine their taxable income together. So you can see that I'm blending the $1 million of income with a $400,000 of loss, and I get a $600,000 taxable income that I now need to apply allocation and apportionment to. Since it's all business income, we apply a strict 3-factor formula to that, and you'd see that I would end up allocating about 36% of that income into state A. Multiply that by the 8%, and I get tax liability of about $17,000. In state B, they get about 64% of the income based on the 3-weighted factor formula. That gives me about $386,000 of taxable income times 11% is about $42,000-ish or so of total income. So you can see in total, that's about $60,000 of income tax, right? So the 17 from state A, the 42 from state B, we've got about $60,000 worth of total income tax between state A and state B. Interestingly enough, because these two entities, one is operating at a loss and one is operating at income, if they're non-unitary, the activities in state A don't pay any tax. Whereas the activities in state B are all taxed in state B at 11%. And as a result, the total income tax is state B's income tax, which is $110,000. So you can see that when you have companies that are both generating income and loss, it's not such a bad thing to have to file under the unitary concept. Okay, believe it or not, we are at the end. This is the last video in this course and the last piece of material you will be responsible for. What comes next is the CBK exam, 25 basic multiple choice questions, and then your final exam, which I'd love it to be 4 hours long, but it simply can't be 4 hours long. So it will be a selection of the items we have seen all semester long, certainly including some items from Chapter 23. Best of luck. I will be all over the discussion board all day Tuesday, all day Wednesday, all day Thursday, trying to respond to any questions you have and trying to get some postings of some solutions to problems you guys had, questions you guys had problems with on Exam 5. All right, thanks for watching.